Over the past 2 days, the S&P 500 has fallen about 1.3% amid escalating airstrikes involving Iran, concerns around the Strait of Hormuz, and renewed geopolitical uncertainty. Whenever oil supply is threatened, markets react quickly, but history gives us a useful perspective. If we go back to 1990 when Iraq invaded Kuwait, oil prices nearly doubled in just a few months. The S&P 500 declined roughly 16 to 20% from late July to its October low. But here's the important point. The market bottomed before Operation Desert Storm even began. Once investors gained clarity that the conflict would likely be limited and short in duration, uncertainty began to fade, oil prices pulled back, and stocks rallied strongly in 1991. Fast forward to 2022 and Russia's invasion of Ukraine. Markets sold off sharply in the immediate aftermath. Oil spiked, volatility surged. Yet within months, broader macro forces such as inflation trends, Federal Reserve policy, earnings growth, and economic resilience began to drive returns again. By roughly 1 year later, the market had largely absorbed the geopolitical shock and refocused on fundamentals. The consistent pattern is that markets tend to price in geopolitical shocks quickly. The initial reaction reflects uncertainty, not necessarily lasting economic damage. As clarity improves, even if the situation remains imperfect, investors shift their attention back to growth, inflation, interest rates, and corporate profits. There's also a major structural difference today compared to 1990. At that time, the United States was heavily dependent on Middle Eastern oil. Today, the U.S. is far more energy independent, with domestic production making it one of the world's largest energy producers. While oil price spikes can still influence global inflation and sentiment, the U.S. economy is less structurally vulnerable than it was 3 decades ago. That does not mean that volatility disappears immediately. Headlines around the Strait of Hormuz can continue to move markets, but history suggests that these shocks are often sharp and temporary, while longer-term economic forces ultimately reassert themselves. At RIMAC, we take the long view during periods like this. Rather than reacting to every headline, we focus on positioning portfolios to navigate short-term volatility while staying aligned with long-term objectives. If you want a disciplined framework for managing uncertainty without losing sight of your goals, you can learn more at rimaccapital.com.